My name is Jed Emerson. I'm advisor to 2 family offices and a major foundation. I have academic appointments at NYU Abu Dhabi and Heidelberg University in Germany, and I'm the Chief Impact Strategist for Impact Assets, a nonprofit financial services group. Impact investing is an investment approach that seeks to track various levels of financial performance together with the generation of social and environmental impacts. I've been involved in impact investing for a long time. I'm not even trying to answer the question because there wasn't a field of either social entrepreneurship or impact investing when I began my work. So I was kind of raised in the field as the field itself evolved. Well, I think those are 3, each of those are areas that are worth exploring. I would say where we've been in the past is a lot of different, let me start over. I think in the past what we've seen have been a lot of different strategies and approaches with different people promoting them almost with a lack of recognition of the connectivity between these different approaches. The analogy that I use is that what we've seen have been a series of block parties where everybody has been gathering around their particular theme or strategy or idea and developing more and more activity until suddenly we can't stay on the block any longer and the party spills out into the avenue. And you have this situation where in the last 5 to 10 years, all of these block parties have been coming onto the avenue, and you look up and down the avenue and suddenly realize that all of this, corporate social responsibility, socially responsible investing, social entrepreneurship, sustainability, all of this is simply one parade. And that's the forward momentum that I think we have really seen build over the last decade. And what's happening, I think, increasingly is people are moving away from focusing on the silos and looking more at the crosscuts and the themes and the ideas that actually bring all of these practices together as opposed to define their differences. Today's environment in some ways reminds me of the old story about going into a dark room and having various actors touch different parts of an elephant, all thinking that the piece that they're holding in their hand or that they're touching represents what an elephant is. What we're seeing are a lot of discussions and debates around definition, around terms, around differences, because people are trying to understand what this is. And I think that we're going to be in that conversation for a period of time. However, at the end of the day, what we're really talking about, to my mind, is simply a question of how do we maximize performance and value creation? And an understanding that performance and value is not an either-or proposition. It's not a question of doing well and then doing good. It's a question of both and recognizing that, in fact, increasingly, if you want to perform well financially, one has to take into account off-balance sheet factors that affect financial performance. And if you want to advance a social or environmental agenda, you have to think about the economic aspects of that issue or that challenge and how to bring these parts together into more of a unified approach or strategy, whether we're talking about organizational management or capital investing. Well, I think of Dan Aykroyd, and in the late 80s, there was a TV show, Saturday Night Live, and there was one of the things that they were famous for were doing these commercials before you went to the real commercial. And one of the commercials that Dan Aykroyd did was for this foam product. And he would be very excited and very promoting, and he would say, not only is it a floor wax, but it's a dessert topping too, right? And when I think of impact investing, I think it's a floor wax and a dessert topping. You can allocate to it as an asset class, as a defined set of investment opportunities. It can also be a lens or a broader strategy that informs how you allocate capital across your portfolio. So it's both and as opposed to either or. I think that the term for the future is simply investing. It's not a question of impact or ESG or responsible, it's simply how you do good business. And I think what we're seeing increasingly, and part of the excitement that's coming into this conversation today, is the fact that there are many people from traditional asset management and capital investing who are realizing that if they want to hit a certain performance level financially, they have to be thinking about off-balance sheet risk, liability, and opportunity. Just as there are a set of actors who are looking for more creative ways to create sustainable impact and value. And it's these parts of this conversation that are coming together, and people increasingly are recognizing that if you care about good investment practices, you really need to care about governance issues. You really need to care about social issues that will affect the workforces of the companies that you're invested in. There are a whole host of issues that traditionally we haven't really taken into account that increasingly traditional mainstream investors are recognizing they have to take into account. In a global environment where you're wanting to operate internationally, if you're not thinking about these factors, you will lose the license to operate, and ultimately you'll underperform the markets as a whole. In the future, investing will simply be done with a broader mindset with regard to the value we're trying to create. What we've tended to do over the past 30 to 50 years has been an over-reliance on econometrics and numeracy as the defining way that we assess value and we assign performance. And so we understand what a price-earning ratio is, we understand how to do valuations of publicly traded companies. The problem is, using econometrics as your sole lens through which you understand value is like viewing the light spectrum and only looking at the visible light. So we see the colors, we see the range of light, but we don't see X-rays or gamma rays or any number of the other aspects of the light spectrum which are there, but we don't take those into account. What impact investing is doing is pushing back the boundaries of the visible light spectrum and saying that if you're an investor and you want to maximize performance and return for your portfolio, we have to think more broadly about the host of factors that will affect financial performance, and we have to understand how investing can drive off-balance sheet opportunity and impact on ways that we just have never really thought about before. I tend not to think in terms of like case examples of, so I think there are other people you're going to talk to who are going to give you better, like, here's this telecom company that did this and that and the other. My perspective around success is the degree to which asset owners are exploring and discovering ways that they can actually drive capital in alliance with their interests and their values and their beliefs, but also in accordance with their fiduciary responsibility to be effective managers and stewards of that capital. And I think what we're seeing increasingly are family offices, foundations, trustees at major institutions who are realizing that in fact this is not simply a trend or a small part of a larger strategy, but rather it's a way to rethink how we execute and fulfill our responsibilities as fiduciaries, and that's really the success story that's moving forward, is the growing number of trustees and asset owners who are recognizing that in fact if they don't take into account issues of environmental, social, and governance factors, if they're not thinking about how their capital can really affect change in the world, that they are actually not fulfilling the fuller vision of what it means to be a good fiduciary and steward of assets. Well, writing the book Impact Investing has been, Writing the book with Anthony Bug Levine called Impact Investing was really an opportunity for Anthony and I to bring our two sets of experiences together. And much of my work over the past 20 years has really focused on how do we understand the nature of value. And much of Anthony's work has been around the whole issue of impact. And when you put these two parts together, what you recognize is that what we do is impact investing and what we create is blended value. And so the book gave both of us an opportunity to reflect on that, to find the better examples that we've become aware of around the world of people who are using capital to create change, and of putting all of that together into what I think is a fairly comprehensive way to think about not only capital but community. The book has done very well. We received the 2012 Nautilus Gold Award for publishing, which we were very pleased to have done, and my publisher was extremely pleased to have seen happen. We've been used it as really a tool to engage in a much broader discussion with a whole host of audiences that to this point were on the periphery of the conversation, and it has helped act as a way to basically introduce these ideas to a much broader set of players than those who were currently just in the field talking to each other alone. I think the thing that I took away from the experience of writing the book was a real awareness that this area of impact investing holds real promise. It has a real sense of energy and optimism about it, and there's nothing that guarantees that this will be successful going forward. That in fact, the success of impact investing, the future of mainstream investing that can take into account some of these broader considerations really rests on a host of other things that need to be advanced in terms of regulation, in terms of leadership, in terms of strategy and development. And there's no guarantee that the potential success of impact investing as a whole will be realized unless these other elements are also addressed. I think that what we're already seeing are a host of initiatives and discussions around what is the best enabling environment to support the better practices of impact investing coming forward. And I think that, as has been true in the past, the concepts and ideas and the regulations governing fiduciary responsibility will really be shifting and changing and evolving over time as we really understand what it means and to drive assets for full value and return and performance. And I think that what people forget is that some of the ideas, some of the regulations that are currently in place, whether it's for organizations and corporations or for fiduciaries, all were written by people. They all came out of processes of folks getting together and seeing a better and a different way to do things. In the state of New York, there was a time when fiduciaries were only allowed to invest in bonds that were offered by the state of New York. And it was in fact the trustees and the fiduciaries who said, we have a broader obligation that is not represented accurately by the regulations that are currently in place. And they were the ones who really advanced a new vision of what it meant to be a fiduciary. In the United States, a lot of the investing work that has been really cutting edge in terms of trustees and pension funds has come out of the efforts to understand the implications of global climate change for the investments that these same pension funds are making. And this is a case where those trustees, working with Ceres and with other organizations, have stepped up and said, in fact, we have to consider off-balance sheet risk and liability, or in fact, we are not managing these assets in the best interests of the people of the states that we represent. So I think there are many examples of this going on where there's a real sense of tumult as people try to understand the current challenges of today and what the regulatory structures need to be in place in order to allow us to address those challenges in an effective way. Impact investing is just one part of that larger conversation. I think what we're seeing is a movement toward leaders who understand this broader vision. There are, of course, a host of different ways to think about leadership. And there are levels of leadership at the organizational context. There are levels of leadership as stewards. There's levels of leadership in terms of people who are advancing new ideas and pointing out new practices that are promising in terms of the work that we all care about. At the end of the day, leadership needs to be about an understanding that we are not accountable simply for our organization and its resources, but rather we should all be accountable for the broader agenda and strategies that will provide for not just our organization, but our field, our community, in fact, our country and the world. And I think what we're seeing is a real sense that, in fact, the leaders of tomorrow are those who will step forward with a new vision that addresses the particular concerns of their constituency, of their own organization, but does that with a reference and with perspective around the context within which our organizations operate, within which our people live their lives. And that's really what I think we're seeing in the whole rise of social entrepreneurship, is this idea that, in fact, entrepreneurs create phenomenal value, and we can take those traditional entrepreneurial practices and apply them in a broader context where they can provide innovation and real power, not only to their own organizations that they create, but for the broader community of which those organizations are a part. The whole idea of doing well and doing good is itself based on a bifurcated understanding of value that would ask you to believe that those are two separate things. What has shifted, I think, in the last 10 years has been a growing awareness that, in fact, we have to advance beyond a bifurcated understanding of value toward a blended understanding of value. And if we look generationally at how different people, broadly speaking, and this is grossly unfair to lots of people in different generations, but broadly speaking, over the last, let's say, 50 years, the dominant way that we approached our life's work was to say that, in fact, you would go out, you would be successful in the market, in business, in whatever career that you chose, and then you would turn your attention to doing some kind of good afterward. Then I think in the last 20 to 30 years, you saw a new generation that came up that said, in fact, I want my entire life to be about good. And so you had the 60s and the 70s, and you had this whole rise of advocacy and social justice movements that basically viewed business and capitalism as evil and bad, and in fact as preventing us from doing good, from being the full people that we're called to be. What has happened in the last 10 years has been this latest generation has come to the table and rejected the premise of either or, and rejected the idea that you cannot engage in profit with purpose. And so they're not willing to work for 30, 40, 50 years and then set up a foundation to do something good to make up for all the things that they did during the 30, 40, or 50 years that they were becoming successful. I think that Einstein has a great quote where he says that we should seek to be not people of success, but people of value. And I think that that's really what this is about, is people putting these aspects together and recognizing that we do not have the opportunity, we don't have the luxury to wait until tomorrow to create the world that we want to have today. And so it's the coming together of these different ideas that I think has been so powerful, and it's the phenomenal way that different people coming together, thinking that they're so different in their perspectives, are actually finding a great deal of commonality. And that's really an exciting part of the discussion as well. I think actually it is more mainstream than people understand. I think that part of the conversation around the need to take sustainability mainstream, the need to take impact investing mainstream, the need to take environmental, social, and governance practices mainstream, the reason that people are asking those questions is that they're from those silos. And when they look out, they say, well, that person is not using my language to describe what's happening, so therefore we're not mainstream. If you step out of the silo and you actually look at the shifts in practices at corporate levels, you look at the degree to which the nonprofit sector is becoming more and more astute at how to leverage economic value and impact and manage capital for impact, you look at any number of innovations in terms of corporate, organizational, and capital performance reporting standards and practices, all of this is being brought together into a more coherent whole. And so, in fact, I would argue that many of these conversations actually have already gone mainstream. And what we're missing is the idea that, in fact, that's happened because we're blinded by our own short-term perspective. So that if somebody isn't using exactly the same terms that I use, somehow they're not doing the right thing. And I think we need to shift the conversation. And this is why I've, over the years, have really become agnostic about terms and concepts and ideas, because all of it, to my mind, is simply a function of value. And so whether you're a nonprofit, a for-profit, a hybrid, whether you're a strategic philanthropist or an impact investor or a mainstream investor trying to maximize total performance, I really don't care anymore, right? Because at the end of the day, we're all involved in a very similar conversation with very common ends. And the trick is really, how do we maximize all of our work in this area and share ideas and emerging best practices in a way that benefits this total conversation and not simply the particular silo that we may have entered the conversation from. I think that there was a time when I thought that if I wrote a really good paper or produced a really good book, that would be it, right? That people would just read it and they would just say, bam, that's the ticket, right? I'm going to use that language, these ideas. What I've realized, and again, this is simply a function of age, is that everybody comes to this conversation along their own paths, and that there are many ways that people can summit the mountain. There isn't just one path. And so I don't think that I have to go out and do any more than I'm already doing to advance this conversation or these ideas, because I have full faith and trust that in the next room, in the next block, in the next community, in the next country, there are 20 other people having exactly the same conversation, advancing their ideas toward that same summit. And the celebration that I think we need to really keep in mind here is that we're all getting there, and you can see it. You can just see it when you look across the countries, when you look at the blogs, when you look at the reports from companies today as opposed to 20 or 30 years ago, when you listen to what young people are talking about, when they talk about success and leadership. This is happening. It has gone mainstream. And so I don't have to worry anymore about going out there and giving one more talk that's going to put the conversation over the top, because we've already gotten there. I think the best thing that can happen for the successful execution of an impact investing strategy is transparency. I think that there are many successes out there. There are many practices that funds and firms are engaging in. There are many investors who actually are moving significant amounts of capital every day that we just don't hear about. And I think that if we're concerned about the broader field, if we're concerned about growing this conversation, we need to understand that those investors who are investing, this is not your father's investment strategy where it was inappropriate to talk about wealth, where you didn't talk about the best deals that you had, where you basically would lose your edge if you shared information with your competitors. In this conversation, it's about talking about what we're doing. It's about the success and the impact that we're creating. It's about documenting our processes in a way that others can look at, replicate, can challenge. This is how the field is going to go forward in terms of really taking the knowledge that comes out of practice and disseminating it broadly so that those who would become practitioners of impact investing can also encounter the same success and experience and celebration of capital that those of us who've been involved in this conversation so far have been able to participate in. I think that one of the points where I realized that we were moving forward significantly in our work was the time when I was reading an interview with Bill Gates. And I'm not sure of the specific quotes, but the basic gist of what he was saying was that he reached a stage in his evolution as a philanthropist where he suddenly realized that he did not have enough money to change the world and to have an impact on the things that he cared about. And that his understanding of philanthropy had to really move and evolve away from simply the transaction of the grant and toward a much deeper strategy around partnership, around how we can mobilize markets, around how we can work with the governmental sector to, again, create a regulatory and a public policy environment that can support the kind of things coming forward that we want to see happen. And so I think that what we need to begin the conversation with is an understanding of the reality that regardless of how wealthy you are, regardless of how great your philanthropy is, grant making alone is not going to leverage the level and the depth of impact that we all seek. And so we have to expand the toolkit, and we need to understand that in fact impact investing, because it provides so many different options for how one can think about and structure capital to complement philanthropic investments, is really a very helpful kind of toolkit to bring to that conversation.
Great explanation. That's exactly what we were doing.
Good.
What do you think are the most significant challenges right now in bringing in more investors and educating more people as to how this is done?
I think perhaps today one of the larger challenges to really moving more significant amounts of capital into this conversation is the fact that many people approach the discussion thinking that in fact the plane has already been built and all we have to do is take off. And in fact, in reality, I think that what we're looking at is a period of probably 5 to 15 years of really bringing innovations together, of experimenting with what's called capital stacking, where you basically take philanthropic investments at one level and marry them together with below market rate debt or equity investing at another level, which then lays the foundation for commercial market returns at a third level, where we need to understand that these are not off-the-shelf strategies or tools, and we need to continue to experiment and innovate as we go forward in this process. And I think that many people who hear about impact investing somehow think that it's either an easy add-on to an existing practice or that they can simply trust that somebody who says that they're creating and introducing a new impact investing vehicle or platform are in fact creating impact. And it's kind of interesting. I'm reminded of the current debate, the current scandal around LIBOR, which is the London interbank rate, which is the...
Start you on that, please.
Sure.
Sorry. Same thing. Go on.
So what I'm reminded by is the current scandal around LIBOR, which is the bank rate that banks use to lend to each other on an overnight basis. And recently, as you'll remember, there was a huge uproar when people realized that in fact the LIBOR rate was being fixed by different traders in the market. And it struck me as, on the one hand, sad, but on the other hand, humorous, because we have this idea that somehow, because it's the LIBOR rate, that it has deep integrity and it's been well thought out and it's proven itself, right? And in fact, it's just a bunch of folks who sit around and trade against each other's notes, right? As we think about impact investing, we need to be as cautious about some of the innovations in impact as we would be in assuming that a LIBOR rate is in fact accurate. And so what I'm asking for is that we not rush to condemn innovation, but that we also not prematurely celebrate innovations that are being brought forward by institutions or funds or individual actors who, in their enthusiasm for the strategy and the ideas and in their commitment to try to bring this to a larger audience, maybe are prematurely selling success, when in fact we're all working towards success, and that's really the best part of the journey, if you will. If this were already done and everybody knew how to do this, I certainly wouldn't be involved in the conversation today.
Tell me, or talk to us about GIN and DIRTS.
Well, GIN is the Global Impact Investors Network, and it was brought together by Rockefeller Foundation and a few of the leading impact investment groups about 3 or 4 years ago. And the idea was that there was a need to have a platform, a community, a network that could bring together some of the leading practitioners in impact investing and give them their own opportunity to discuss what they were learning, how they were thinking of impact, and the practices that they were advancing. GEARS comes out of IRIS, and this is where we get into the alphabet soup. But IRIS is basically an effort to standardize a set of indicators with regard to impact. So in the same way that you have a standard way to engage in accounting, you would have a standard way to engage in documenting the impact that your dollars were having through a given fund or a company. What GEARS does is try to raise that up to the next level then and say, well, if these are the standards, then what are the host of practices that we want to see across the board, and how could you take those ideas of the language of impact investing and convert it to the best practice of impact investors. And so GEARS looks at that broader universe of practices and is advancing that as it builds on refining the specific definition of impact that IRIS offers.
Great. And can you just tell us what GEARS stands for?
Global Impact Investing Reporting System. I think.
Great. Tell us about your nonprofit and why you put together a nonprofit.
Sure. Well, Impact Assets was founded by Ron Cordes, who was a traditional mainstream investment. Let me try one more time.
No problem.
Impact Assets was created by out of a conversation from Ron Cordes, who was the founder of Asset Mark, which was a fund-to-funds platform for traditional broker-dealer networks, and Tim Freundlich and Wayne Silby out of the Calvert Foundation. And the idea was that in the traditional for-profit space, you have these platforms that allow you to kind of take larger amounts of capital on the one hand and invest it in smaller opportunities on the other. It allows you to bring impact investing to the retail level, if you will, because a lot of impact investing today is really done by foundations or ultra high net worth individuals who hire people to construct portfolios and strategies. But if we really want to see impact investing go to scale, we need to figure out a way to make it more accessible to the mainstream. And so what Impact Assets is working on are basically two set parts of a related strategy. So what Impact Assets is working on are two parts of a related strategy in order to increase the flow of capital into the impact investing arena. And we're doing that in two ways. One is by helping people understand what the impact opportunity is. And so within that strategy, we are conveners and producers of the IA50, which is a landscape overview of firms that are advancing impact strategies across different thematic areas and different investment approaches. It's not an investable index, it's not a best of list. What it is it says to a potentially interested investor, here's a starting place. Here are 3 or 4 firms that are active in microfinance, in sustainable ag, in water, whatever the categories are. And it's up to you in your inquiry to figure out, which of these or other funds really fit best for your interest. But here's a place to begin, because a lot of people, when they come into the impact investing conversation, really have a difficult time getting a lay of the land and understanding what is an impact firm and how do we think about this. Related to that is our issue brief series. And what we've done is recognize the fact that many people will not read a 150-page report from the Rockefeller Foundation. They may not read our book, as tragic as that might be. And instead, what they may read is a 10 to 15-page long-form essay on a particular topic that's of interest to them. And so Impact Assets, by the end of this year, will have a library of 18 to 20 of these issue briefs that can be helpful for high net worth individuals or advisors to high net worth individuals who are working to really understand what impact investing is all about. And so each of the issue briefs addresses a different topic with regard to performance, with regard to how to think about impact investing, with regard to everything as diverse as public equity and impact and private equity in frontier markets and impact and everything in between. And so that element of what we're engaged in is simply trying to help people understand what this is. The second part is an investment approach, which says that we have now today anywhere from 200 to 400 different firms and funds that are operating around the world. And a lot of these funds are, quite frankly, operating at subpar levels. That to really execute their strategies effectively, they really need more investing dollars, they need more capital on terms that make sense for them. And so what Impact Assets is in the process of creating are a set of strategies that would basically allow you to roll up some of these underlying firms in different thematic areas and offer them then, connect them in with other sources of capital that otherwise would not be able to connect with those firms and funds. And so we're working to create almost an intermediation between the investment opportunity and the capital markets. And so that strategy will roll out in the next year to 2 years. I would argue that the best way to educate the larger population is to simply begin where they enter the conversation. I think that for many years, this has in some ways been an insider discussion among people who have been most passionate, who've been most engaged, who have really led the way, and that's great. The challenge is that when newcomers enter that discussion, there are acronyms, there are terms, there are assumptions that the people who are having the discussion are using that a newcomer doesn't understand. And so for those of us who are committed to expanding the discussion, to increasing the capital flow, to really seeing impact investing achieve its potential, we need to really focus on a variety of ways that we can simply engage people where they are to help them see how impact investing can complement where they want to be. And this is really, I think, one of the more fun and exciting parts of the discussion. And it's why I've chosen myself to focus on working with just a couple of family offices and a foundation, because it's through that kind of deep engagement in practice where you're really confronted in a very real way with the challenges of putting these ideas to work. And so I think that the more that we ground our rhetoric and our vision in the particular strategy and the execution of these ideas, the better we'll be able to have conversations with people who are new to the discussion, who have the intent and the interest, but not necessarily the skill set or the awareness of how you go about doing this. And I think that's really where we're seeing now a host of new advisory groups and firms enter the market. We're seeing more and more interest from traditional financial advisors who are wanting to add impact to their portfolio of offerings for clients. And we're seeing more and more clients who are making those demands of their wealth advisors, of their the places where they place their investment dollars, because they want to see this come forward as well. Well, so here's the thing. To quote Albert Einstein yet again, all right, they may not know I've quoted him before, so let me start again. To quote Albert Einstein, he was asked once about the theory of relativity and was questioned on how complex it was and how do you make it something that people could really understand. And his response was to say, the fact is, it's really very, very simple, but that doesn't mean it's easy. And so when we talk about complexities of the practice and how hard it is to do this or that, or the need to be very sophisticated as an investor to be able to understand how these different instruments and strategies are brought forward, on the one hand, we could certainly talk about that. On the other hand, it's really very simple. All we're saying is that the nature of value is whole. It's non-divisible. That when you invest, you cannot invest in the absence of understanding the environmental and social context within which your investment is made. And that if you seek to generate and create financial performance and return, that in fact you have to consider off-balance sheet risk and liability, because the world is an increasingly small place. And as people have said, there is no away. There's no such thing as externalities. You can't pretend that you can run a business in a certain way that may add costs to the communities within which you operate and not think that those expenses are not going to be brought back to bear on your company today. And if you're an investor, you need to be understanding these realities as they evolve. And so on the one hand, there are any number of approaches, there are any number of ways that you can think about it. There are frameworks, there's metrics, there's all sorts of things, and you can get all tied up in the supposed complexity of what is actually a very simple idea. I think that there, on the one hand, is a real sense of promise in the work that's going on, and I also think that there is some great risk, because what's happening is the expectation levels are being ratcheted up, and people are viewing impact investing and social entrepreneurship as strategies that will change the world in permanent ways, that will save us from 200 years of rampant capitalism that's destroyed the planet. And in fact, I think that's a lot of expectation to place on a 20-year-old set of practices and field that's still emerging. My fear is that the damage that we have done, that the challenges that we confront, the complexity of the issues that threaten our very lives are in fact so deep that any one strategy will not be enough, and that as we see failure, which we must see if we're truly innovating and experimenting and trying to do things that are non-traditional, that those failures will be held up as, in some sense, a condemnation of the ideas and the practices that we're all working to advance. And I think if that were to happen, it would be a real shame. And I think that we need to keep in mind a broad perspective of the evolution of history. We need to keep in mind an understanding of the deep, deep dysfunctionality of the existing systems that many of these impact and social entrepreneurship strategies are trying to address. And we need to recognize that we may not be successful, but we will certainly have been successful in making the effort to try to change the world today. The best way for us to help the next generation of leaders and managers in this conversation is to put more capital to work in order to create more opportunities to invest, to provide those new managers with experiences that will help them learn in short order. We need to explore more ways to connect these new practices with existing practices in socially responsible investing, in mainstream traditional investing, in order to really understand how to connect what we knew with what we are knowing and what we are about. And I think that as the next generation increasingly moves in to positions of leadership, they'll bring all of that to the present conversation, to the future practices that they're advancing. And they have to understand that in some ways, what they are doing is new. It has not been done before. In other ways, we know how to do this. We are literally standing on the shoulders of giants who have gone ahead, who pioneered impact investing through the vehicles of screened and responsible investing practices. We are building on the work of those who understood that screening and those types of practices were critical for those people who sought that out. And yet it was not enough, because we needed to come up with better ways to integrate environmental, social, and governance elements into our consideration of investing and of performance and of value, and that those practices will not be enough for the next generation, who will then pioneer the third, fourth, and fifth iterations of what's called impact investing. And so we need to make sure that as the new generation comes into this discussion, that they're fully aware and appreciative and cognizant of all that has come before, in order to position them to have the successes that they will have in their careers over the next 20, 30, 40 years. The challenge represented by having a conversation about impact investing with traditional Main Street, the challenge of having the conversation about impact investing with traditional Wall Street actors is that there has been of course, a certain way that we've thought about investing, and we have allowed the practices of Wall Street to really become separated from the interests of Main Street. And in many cases, we've allowed the interests of the managers of Wall Street to become separate from the interest of the very people whose money they're managing. Even if they're ultra high net worth families and clients who are named individuals and not the amorphous mass of Main Street, we still are in a situation where you actually are incented to trade paper. You're incented to create value and profit for the firm before you are incented to really add value and impact for the family or for the firm that you represent on the street. And so the challenge that we're having is that we've got a system that basically encourages you to pursue financial return at the expense, oftentimes, of client interest. And so figuring out how we bring that together, I don't think impact investing is the answer to that huge challenge that we have as a country and in some ways as a world. That said, impact investing is one way that we can find our way back to an approach to investing in capital and asset management practices that really does add the greatest value possible for the investor as well as for outside stakeholders in the community. I don't believe that the pursuit of profits in the absence of context of community is sustainable profits. And at the end of the day, even if you only care about profits, you have to think about 10, 20, 30 years out what that will mean by pursuing those profits to the exclusion of other considerations of value. What we did in terms of approaching a strategy for publishing the issue briefs was to say, what are the conversations that high net worth individuals are having with their wealth advisors, with their financial advisors? What are the discussions and the questions that they're raising with the impact firms that they're in conversation with about whether or not to invest? And could we create a set of documents that would help respond to some of those questions in advance so that the discussion could begin a little further down the road? And so, for example, one of our pieces is a very broad piece about a unified investing approach. And how do you think about an investment strategy that views all of your capital as a whole and says that there are various ways you can allocate that capital to maximize the performance that you seek to have as an asset owner, as a fiduciary. Another piece that we have is called Performance, Risk, and Return. And it explores this whole question of, as we think about an impact investment, what's the nature of the performance that we seek? Are there trade-offs between financial and social and environmental pursuits? Which I would reject, but are there? Because there are those who would argue there are. And just giving a set of documents that people can at least start a conversation around. And I think the trick here is with the issue briefs, and I think broadly speaking, I'm not arguing that there is one way to go. I'm not arguing that there is a single answer for what a good impact investment strategy should look like. I am arguing that asset owners, whether trustees of foundations or family offices or whatever the make, have an obligation to really understand for themselves what's the true nature of the value they're trying to create. And in fact, what are the variety of tools that can be applied in pursuit of that? We will have the right answer when 6 different people can sit down at a table and describe their impact strategy, and we have 6 different strategies and everybody understands that they're all about impact. That's the place we need to get as we try to define what is impact investing and what's the right way to go about it. I don't think there is a right way. I think there are really good ways to go down the path toward creating greater impact and having greater accountability for your capital. And the right answer is going to look different for different investors pursuing different approaches. I go back and forth on the metrics question because I think in some ways, I go back and forth on the metrics question. I spent over 10 years promoting social return on investment as a way to think about extra financial value and performance. We were, with the REDF, the Roberts Enterprise Development Fund, among the first to formalize a methodology around monetizing the economic value of social impacts. So I'm a big advocate that we need to understand how to measure, if nothing else, because we have to manage differently in the future. So we need to understand what is the performance that we're trying to manage toward. That said, I also think that one can go overboard and try to have too much of a focus on metrics and measurement, which can sometimes get in the way of actually making sound investments. And there are a host of different elements and aspects to performance, and we need to quantify those aspects which can be quantified. We need to take more of a quantitative lens to some of the qualitative performance issues that people would have us believe are taking place. And at the end of the day, we need to invest in people and communities. And there are simply going to be elements of how people live, who they are, what they do. There are aspects of communities, how they function, how they improve, how they work as an ecosystem, that are simply going to be beyond what we can, quote, measure. And I'm completely comfortable with that. And I think what I'm asking for is that we advance and create a more holistic approach to our understanding of performance and recognize that within that broad banner of performance, we will have various tools and techniques and approaches that will be in some cases more quantitative, in other cases more qualitative, but it's that aggregate perspective on what is happening that we should focus on, as opposed to having endless discussions about how many social entrepreneurs can dance on the head of a pin, or what the full causality was because of our investment, right? Could you draw? It's good enough to be proximate to success as opposed to be driving success. And I'm comfortable with that because that's just the way the world is. I think the first myth that we have to address, but this is where it gets hard, right? Because I actually don't have this conversation anymore because I'm just done, right? I think that there are people out there who will want to continue to have discussions about risk and return. There are people out there who would tell you that impact investing and microfinance and a whole host of other related thematic areas are very high-risk areas that we should go into. The reason that they are risky, the reason they are viewed as risky by traditional investors and asset managers is that these people don't know how to work in that environment. So of course it's risky. That said, we have built over the last 30 years real expertise in grassroots community finance, development, lending, microfinance, environmental finance, just a whole host of areas that the knowledge has not really transferred yet to the mainstream. And so the mainstream still looks at these and says, gosh, how could you do that? How could this happen? How does this work? That's just too risky. So I reject the idea that impact investing is risky. I especially reject it in the aftermath of 2008, where we saw portfolios that supposedly had been constructed with consideration for diversification of risk that were built on the backs of the algorithms and the Monte Carlo scenarios and the whole host of tools that traditional asset managers use to allocate capital, and that were supposed to give us non-correlated performance. So that in fact, if one part of the portfolio sunk, another part would at least not go down as bad. And instead, what we saw was entire portfolios going right into the toilet. So the idea that somehow traditional investing is very thoughtful and quantitative, and we can prove that our theories work, well, reality proved those theories wrong. And when I talk with various ultra high net worth individuals who are thinking about coming into impact investing, one of the first parts of the conversation is, at least if I lose my money in a microfinance deal, I will be able to see and understand what happened. Whereas my wealth manager 3 years later still cannot explain to me how a third of my assets evaporated. I think that's a very strong indictment of the idea that traditional risk and return is the mindset that we should bring to this practice. And the mindset we should bring to impact investing is one of total performance. It's one that says that we have a portfolio of assets that range from philanthropic to below and near market to commercial market return in terms of what we're seeking with that capital. And we need to manage that portfolio for total performance. And when you take that approach, then you understand that it's not an either-or kind of function. It's not a risk-return function. It's a function of performance, and it's a function of how are we managing those assets to maximize the total value that the investor seeks. Not that the market has set with some sort of relatively arbitrary structure of value and return, but rather these individual investors are the market. They are the ones who are saying, this is our capital, these are the terms that we want to place it on, this is the type of risk that we want to take on, this is how we understand risk in a different way. And with all of that, this is the value we seek to create. And so for me, the whole conversation about risk and return and market rate and are they competitive returns, I'm like, I don't even understand what a competitive return is anymore. Well, the nonprofit allows us to work in a variety of ways to be able to pursue a variety of goals. And it gives us more flexibility in terms of pursuing the field building agenda and be able to spend our resources building the field as opposed to returning value to the shareholders who launched a for-profit company. The other thing is that there's really nothing new about nonprofit financial services group. TIAA-CREF, which is one of the largest wealth management groups in the country, is a nonprofit entity, or at least has been for a majority of its time. You're going to have to edit that part out because I kind of dribbled off. And I can't remember, I'm pretty sure it's a nonprofit, but they may have created some alternative structures recently. But anyway, so I mean, there are examples of that. So it's, it's important, but it's not. So I think that what impact investing really offers us is an opportunity to reframe an understanding of what we know. And I think that traditionally we've viewed the world, we've viewed reality as these, again, kind of two parts. And what we're recognizing is, in fact, we need to understand the world in a more unified, a more holistic, a more integrated way. And what impact investing gives us is a vehicle to begin exploring through how we manage our financial assets to understand that level of connectivity that we have in the world today. We live in a market-driven world. Capitalism has triumphed, and yet at the very same time, we're living in a world in decline. We're living in a world that is really, if it hasn't already reached its limits, is approaching its limits. And we need to have a fundamentally different way to think about what this is. And I think that impact investing is a very small example of a way that we can blow out our understanding of what's real and what is known and embrace a deeper, more sustainable, more impactful approach to the purpose of not only capital, but the purpose of our lives, the purpose of our community, the purpose of our companies, that these are not simply means to an end to create wealth. They are the means to the end. And we need to understand more deeply what that entails. And I think that when I sit down with individuals who are considering impact investing, the first conversation we have is not about what kind of return do you need, what's your cash flow requirements, what's your risk comfort levels. The first conversation we have is around and this may sound a little direct, but is around the idea that when you die and you look back, as you're on your deathbed and you consider the value that you've created over the trajectory of your life, what will that value consist of? And it is not a question of success, it's a question of value creation and kind of deep impact for one having lived a life. And that really, in a very simple way, is what this conversation is about. And we can create all kinds of complexities around the execution, the definition, the term, the metrics. And at the end of the day, it's simply about how do you live your life to the fullest, and how do you do that without creating greater costs to the person next to you, or to the community next door, or to the country across the ocean from you. And this really is the phenomenal opportunity that I think the impact conversation has brought forward. Because it's not simply a question about how do you manage your assets. It's not just about how do you invest effectively. It's about how do you mobilize the total resources at your disposal in order to have had the greatest, deepest impact for your having lived a life. And that, to me, is just what it's all about. No, I think that was my closing remark.
I was going to say, that's about